If gold is sitting around $4,400 and silver is holding around $64, then the next move may not be about the price chart alone. The real signal is buried inside the latest Federal Reserve minutes. The Fed just showed investors something very important about the fight against inflation. Some officials want tighter policy, others want more patience. That split could create a major move in gold and silver. The question now is simple. Does the Fed stay restrictive, or does the economy force it to change direction? And what does that mean for your gold and silver holdings? Stay with me because the answer could shape the next major move in precious metals. Gold has entered a very interesting phase. The metal is trading near levels that would have sounded almost impossible only a few years ago. Silver is also trading at levels that are attracting serious attention from investors around the world. Yet the most important part of this story is not simply that gold is near $4,400 or that silver is near $64. The bigger story is what happens next. The Federal Reserve has released the minutes from its latest policy meeting. Those minutes give us a much deeper look into what policymakers were actually thinking behind closed doors. And what they reveal is not a simple story. The Fed is divided. Some officials remain concerned that inflation is too high. Some believe additional tightening could still be necessary. Others want to wait and see how the economy develops before making another move. That disagreement matters. It matters because gold and silver react strongly to expectations about interest rates. When investors believe rates will stay high for longer, gold can face pressure. When investors believe rates could eventually fall, gold can become more attractive. Silver reacts to the same monetary forces, but it has another major engine behind it: industrial demand. That makes silver a unique metal. It can benefit from investment demand at the same time that it benefits from manufacturing demand. That combination can create powerful moves when financial conditions become supportive. This is why the current environment deserves close attention. The Federal Reserve held its benchmark interest rate in the 3.5% to 3.75% range at the July meeting. 3 officials dissented and wanted a 25 basis point increase. The latest minutes also showed broader support for a possible increase if inflation remains stubborn. That is a major signal. But there is another side to the story. Recent economic data has not created a clear case for aggressive tightening. The labor market has shown signs of cooling. Inflation data has been softer in some areas. That creates a difficult situation for the Fed. If policymakers raise rates too aggressively, they risk weakening the economy. If they stay too easy for too long, they risk allowing inflation to remain above target. This is the trap that precious metals investors need to understand. The Fed is trying to control inflation without causing unnecessary economic damage. Gold sits directly in the middle of that battle. Gold does not pay interest. A treasury bond does. A money market fund does. A bank deposit can also pay interest. So when interest rates and real yields rise, investors have more reasons to hold income-producing assets. When real yields fall, the opportunity cost of owning gold becomes smaller. That can create powerful support for the metal. This is why the bond market may be more important than the Fed headline itself. Watch Treasury yields, watch real yields, watch the US dollar, and watch what investors expect the Fed to do next. These signals can sometimes move before the actual policy decision. That is exactly why the latest Fed minutes deserve attention. The minutes show that several policymakers were open to higher rates. Many officials believed additional tightening could become necessary if inflation remained elevated. At the same time, the market has not fully accepted the idea of a September rate hike. That disagreement between the Fed and the market is extremely important. Markets trade expectations. They do not trade yesterday. If traders believe the Fed will eventually have to cut rates, then gold can rise even while current rates remain high. If traders suddenly believe the Fed will raise rates, then yields can jump and gold can fall. This is why precious metals can move sharply on a single economic report. The market is constantly trying to predict the next move. Right now, the prediction is complicated. Inflation remains above the Fed target. Energy prices are creating additional inflation risk. Geopolitical tensions are keeping investors cautious, and the government bond market is sending unusual signals. That last point deserves special attention. Long-term Treasury yields recently reached levels not seen in many years. The US Treasury then announced an expansion of its long-term bond buyback program. That announcement helped push Treasury yields lower and weakened the US dollar. Gold responded with a powerful rally. This is a perfect example of why gold is not controlled by one single factor. The Fed matters, but the Treasury matters, bond yields matter, the dollar matters, inflation matters, geopolitics matter, investor positioning matters, and central bank demand matters. When several of these forces move in the same direction, gold can react very quickly. We saw exactly that recently. Gold jumped more than 4% in one session after the Treasury announcement pushed yields lower and the dollar weakened. Silver also moved sharply higher. That move tells us something important. There is still significant demand for precious metals. Investors are not simply buying gold because they expect inflation. They are buying because they are concerned about the broader financial system. Government debt is enormous, fiscal deficits remain large, currency confidence can change quickly, geopolitical risk remains elevated, and central banks continue to treat gold as a strategic reserve asset. This creates a powerful long-term foundation, but that does not mean gold moves higher every day. In fact, the latest price action proves the opposite. Gold pulled back after the recent surge. Spot gold was recently around $4,485. Silver was around $66 at one point during the session. The exact price changes throughout the trading day, but the broader message remains the same. Precious metals are experiencing major volatility. That volatility is important. When markets move this quickly, there will be profit-taking, there will be pullbacks, there will be false breakouts, there will be days when gold rises while silver falls, there will be days when silver explodes higher while gold barely moves. That is normal. The question is whether the underlying trend is changing. For gold, the major question is whether the metal can maintain support after its recent rally. The $4,400 area has psychological importance because the market has spent significant time around that zone. If gold holds above major support, then bulls may continue looking toward the next resistance levels. If gold loses support, then traders may start looking for a deeper correction. But the most important variable may still be yields. Suppose inflation remains elevated. Suppose oil prices continue rising. Suppose the Fed keeps warning that another rate increase is possible. That could push Treasury yields higher. Higher yields could strengthen the dollar. That combination would create pressure on gold. Now imagine the opposite. Suppose employment weakens. Suppose inflation continues cooling. Suppose economic growth slows. Suppose investors begin pricing future rate cuts. Treasury yields could fall. The dollar could weaken. Gold could regain momentum. This is the two-sided battle happening right now. And silver could become even more interesting. Silver is not just monetary metal. Silver is also an industrial metal. It is used in solar technology, it is used in electronics, it is used in electrical systems, it is used in advanced manufacturing, it is also important in many emerging technologies. That means silver can benefit from economic expansion, but it can also benefit from monetary demand. This dual role is why silver can sometimes outperform gold during major precious metals rallies. It is also why silver can fall much harder during periods of stress. The silver market is smaller than the gold market. That means relatively small changes in investment demand can produce large price movements. At around $64, silver is already attracting huge attention. The market is asking whether this is the beginning of another major leg higher or whether the metal has moved too far too quickly. There is no guaranteed answer, but there are signals worth watching. One of them is the gold to silver ratio. When gold becomes extremely expensive compared with silver, the ratio rises. When silver begins outperforming gold, the ratio falls. A falling ratio can indicate that silver is gaining relative strength. That can become important during a strong metals bull market. The recent rally has already shown that silver can move aggressively. Recent trading showed silver gaining strongly even while gold experienced a pullback. Kitco reported silver near $66 during one recent session while gold was under pressure. That divergence is worth watching. If silver continues to outperform gold while the dollar weakens and yields fall, then the precious metals rally could broaden. But if yields rise sharply and the dollar strengthens, then both metals could face pressure. This is why the Fed minutes are important. They tell us how policymakers view the inflation problem. The minutes show that many officials still believe inflation risks are significant. That means the Fed is not ready to declare victory, But markets are looking at something else. Markets are looking at the economic data. If inflation keeps cooling, then the Fed may have less reason to tighten. If the labor market weakens, then the Fed may have even less reason to raise rates. This creates a situation where the Fed can sound hawkish while markets remain bullish on gold. That may sound strange, but it happens because investors trade the future. Gold can rise even when the Fed is warning about inflation if traders believe those warnings will eventually lead to economic weakness. Think about the chain reaction. Higher rates slow borrowing. Slower borrowing can reduce demand. Lower demand can weaken economic growth. Weak growth can pressure employment. Weak employment can force the Fed to reconsider policy. That possibility can support gold before any rate cut actually happens. This is why investors need to think several steps ahead. The biggest mistake is to look at one Fed statement and assume you know what gold will do. Markets are much more complicated. The US dollar is another critical piece. Gold is priced in dollars. When the dollar weakens, gold becomes cheaper for international buyers. That can increase demand. When the dollar strengthens, gold becomes more expensive for foreign buyers. That can reduce demand. Recent dollar weakness helped precious metals rally sharply. Reuters reported that the dollar index fell around 0.8% during the recent gold surge. That is not a small detail. It is one of the reasons the metals reacted so strongly. Now add falling treasury yields. Then add geopolitical uncertainty. Then add strong central bank demand. Suddenly, the bullish case becomes much stronger. Central bank buying is particularly important because it represents a different type of demand. A short-term trader may buy gold today and sell it tomorrow. A central bank can buy gold as a strategic reserve asset. That demand can remain in the market for years. This changes the structure of the gold market. It creates a foundation that can remain even during temporary corrections. Silver has a different supply problem. Mining silver is difficult because much of the world's silver is produced as a byproduct of mining other metals. That means higher silver prices do not always create an immediate surge in new supply. If demand rises quickly, then the market can tighten. That is one reason silver can become explosive when investment demand returns. But investors need to remain realistic. Silver is volatile. A move from $64 to a higher level can happen quickly, but a sharp correction can happen just as quickly. That is why the most important question is not whether silver can rise. It is whether the market can sustain higher prices. For that, we need to watch physical demand. We need to watch industrial demand. We need to watch exchange inventories. We need to watch investment flows. And we need to watch the gold market. Gold often leads, silver often follows. But when silver catches up, the move can become much faster. That is the setup many investors are watching right now. The latest Fed minutes do not guarantee a precious metals crash. They do not guarantee a gold breakout either. They simply show us that the inflation debate inside the Federal Reserve remains alive. That uncertainty itself can support demand for hedges. Investors hate uncertainty. Gold is one of the oldest ways to protect against monetary and geopolitical uncertainty. That does not mean gold always rises during uncertainty. Sometimes investors sell everything to raise cash. But over longer periods, gold has often benefited when confidence in currencies or financial policy becomes weaker. And that brings us to one of the biggest questions. What happens if inflation stops cooling? If inflation rises again because energy prices increase, then the Fed may become more aggressive. That could be negative for gold in the short term, but there is another possibility. If inflation rises while economic growth weakens, then the economy could enter a stagflation-style environment. That would be much more complicated. The Fed would face a painful choice: raise rates to fight inflation or support the economy to reduce recession risk. Neither option would be easy. That kind of environment could increase demand for real assets. Gold could benefit, silver could benefit, commodities could benefit, but markets would likely become extremely volatile. This is why the next few economic reports matter so much. The market will be watching inflation. The market will be watching employment. The market will be watching consumer spending. The market will be watching treasury yields. And the market will be watching every comment from Fed officials. The Jackson Hole meeting is also important because investors will be searching for clues about future monetary policy. The Fed does not need to announce a rate move for markets to react. Sometimes one sentence is enough. One phrase can change rate expectations. One inflation number can change treasury yields. One jobs report can change the dollar, and those changes can move gold and silver within minutes. That is the environment we are entering. Gold near $4,400 is no longer a distant target. It is a major market reality. Silver near $64 is also showing how dramatically the precious metals landscape has changed. But the biggest opportunity may not be the price today. It may be understanding the forces that determine tomorrow's price. If yields fall, then gold can gain. If the dollar falls, then gold can gain. If inflation expectations rise, then gold can gain. If geopolitical risk increases, then gold can gain. If central bank buying remains strong, then gold can gain. For silver, the picture can become even more powerful if industrial demand stays strong at the same time. But there is a warning. If the Fed becomes significantly more hawkish, then the market could experience a sharp correction. If Treasury yields rise quickly, then gold could lose momentum. If the dollar rebounds, then precious metals could face additional pressure. If investors begin taking profits after a huge rally, then silver could experience a much larger percentage decline than gold. That does not automatically mean the long-term story is broken. It means investors must understand volatility. The biggest mistake is chasing a market after a huge move simply because the chart looks exciting. The second biggest mistake is panicking during a normal correction. Successful investors focus on the bigger picture. They understand why the market is moving. They know which signals matter. And they understand that no single indicator predicts the future perfectly. So what should you watch from here? Watch Treasury yields, watch the US dollar, watch inflation expectations, watch labor data, watch the next Fed comments, and watch the relationship between gold and silver. If gold holds its ground while yields rise, that would show unusual strength. If silver continues climbing while gold consolidates, that would show increasing risk appetite for the metal. If both metals rise while the dollar weakens, then the bullish signal becomes stronger. And if gold breaks higher while silver accelerates, then the market could enter another powerful momentum phase. The key is confirmation. Do not rely on one headline. Do not rely on one Fed official. Do not rely on one price target. Look at the entire picture. The Fed minutes have given us an important clue. The central bank is still fighting inflation. The committee is divided. Some officials want more tightening. Others want patience. Markets are not fully convinced that a September hike will happen. That creates uncertainty. And uncertainty is one of the reasons investors continue watching gold and silver so closely. The next move will likely depend on which side wins the data battle. If inflation stays high, then the hawkish side gains power. If inflation continues cooling, then the patient side gains power. If employment weakens, then the case for holding rates becomes stronger. If growth accelerates and inflation rises, then the case for tighter policy becomes stronger. And through all of this, gold will be watching the bond market, silver will be watching gold, and investors will be watching both. This is why the current price levels are so important. Gold around $4,400 is not simply another number. Silver around $64 is not simply another number. These prices reflect a market trying to balance inflation risk with rate expectations. They reflect concern about government debt. They reflect geopolitical uncertainty. They reflect currency risk. They reflect central bank demand. And they reflect a growing belief among some investors that precious metals still have a major role to play in the global financial system. The next few weeks could therefore be extremely important. We could see consolidation. We could see a breakout. We could see a sharp correction. Nobody knows the exact path, but we can identify the forces that are likely to matter. And right now, those forces are moving quickly. The Fed minutes have made one thing clear. The inflation fight is not finished. The debate inside the Federal Reserve is not finished. And the precious metals story is not finished. If you own gold or silver, then this is the time to stay informed. Do not focus only on today's price. Focus on yields, focus on the dollar, focus on inflation, focus on the Fed, focus on physical demand, and focus on the bigger monetary picture. Gold has already shown that it can move thousands of dollars across a major cycle. Silver has shown that when momentum arrives, it can move even faster. The question is whether this current phase becomes another major chapter in that story. That answer will not come from one headline. It will come from the interaction between inflation and interest rates. It will come from the bond market, it will come from the dollar, and it will come from investor demand. For now, the message is simple. The Fed remains divided. Inflation remains a concern. Gold remains historically strong. Silver remains highly volatile. And the next major move could be closer than many investors realize. If you are watching gold at $4,400 and silver near $64, then do not just ask where the price is going. Ask why the market is moving. That question can make all the difference. If you found this analysis useful, then make sure you like this video and subscribe to Silver and Gold Watch. Turn on notifications so you do not miss the next major gold and silver update. And I want to hear from you. Do you think the Fed will stay hawkish, or do you think weaker economic data will force a change? And where do you think gold and silver will be by the next major Fed decision? Leave your prediction in the comments. Your view could be the most interesting part of the discussion. The precious metals market is moving fast. Stay informed, stay focused, and most importantly, stay ready for what comes next.